Let's go ahead and get started this evening. The skills you need to survive volatility. Many of you probably saw the trading session today, and it was just that, a little bit on the volatile side. A few things right up front. Number one, I always start with a risk disclosure. We are not financial advisors or a broker-dealer. And of course, the reasons we mention that is that it's the business I ultimately came from. I spent the previous 15 years of my career in the brokerage industry. We've also got a copyright disclaimer. You can't rebroadcast this. Only I can rebroadcast this. Also, if you're curious, our office here in Scottsdale, our phone number. And if you ever need to get a hold of me or anybody here at TheoTrade, just support at TheoTrade.com. That actually distributes to all of us here at TheoTrade, whether it's, myself, or Doc, or Jeff, or Tony and Slim. All of us actually receive these emails. A little bit about me, because we've always got brand new people joining us. And we have a lot of new people joining us this evening. The co-founder here of TheoTrade. I've had just about a 19-year trading career. I started trading in Chicago at the ripe old age of 22. A short time thereafter, I was actually invited to a startup brokerage firm. At the time, it was called thinkorswim, and it was eventually acquired by none other than TD Ameritrade. I ran the education division of thinkorswim and went on to actually run the education division of TD Ameritrade and their 7 million clients until we finally we left. We had it with the regulations. People always ask me that, why'd you finally leave? Regulations and so forth. And we launched, of course, TheoTrade. With that, a little bit about TheoTrade, because, you tune in, you're like, I don't even know what a TheoTrade is. Of course, we specialize in education for stocks, options, futures. I mean, for the most part, if you could buy it or sell it, we'll talk about it. Founded by professional traders and trading educators, all of us here at TheoTrade, if we are on here doing a presentation, which I'll discuss here in a moment, we've got a minimum of 15 years of experience. Few have several decades of experience. Here at TheoTrade, what we're doing is helping people mitigate risks, really navigation of the market. And it's a skill set that's going to last a lifetime. And tonight, I'm going to tell you right now, tonight's presentation is just that, a skill set that will last you a lifetime. Also the other TheoTrade instructors, and I never want anybody to think that, TheoTrade is, this is Don, listen, we're myself, Doc Severson. If you guys, anybody know Doc, of course, stocks, options, and technicals. We've got Jeff Bierman. Jeff actually also worked with me at thinkorswim and TD Ameritrade. So before Jeff actually joined TheoTrade, he spent 7 years working with me in my group at TD Ameritrade. He was also the chief market technician for TD Ameritrade. So Jeff's claim to fame, pretty much knows more about technical studies, individualized technical studies, than any other person alive. And we have Steve Miller, 42-year. He's stock options. He's also a futures trader. Steve is also a former market maker for the Chicago Board Options Exchange. Last but definitely not least, Tony Rago, NASDAQ futures and intraday strategist. So we're going to jump right into it tonight. We're coming at you tonight. No holds barred. Again, questions and so forth. Again, the theme tonight, the skills that you need to survive volatility. And this is a slide that I use in a lot of different presentations. As I was saying, I feel pretty strongly about tonight's presentation. The skills transcend. It doesn't matter whether you trade stocks, whether you trade options, whether you trade futures, whether you're an investor, okay? Whether you're just out there mom and pop that want to sell covered calls. The presentation that I am giving you tonight is a direct descendant of a presentation that myself and a few of the original founders of thinkorswim, we built this presentation originally for institutional money managers. I used to run a education division of thinkorswim and then eventually TD Ameritrade for institutional money managers. And this is an exact derivative of that presentation. And it's extremely important. Again, it transcends time, market conditions, and whatever type of investor and or / trader you are. These skills, okay, are possibly the single most important thing that you can grasp There are some skills here that many of you may initially be familiar with, but we're going to take that to the next level. So again, I stress that this evening. We'll take some questions towards the end of the presentation, but I'm also reading, the chat rooms during the presentation. Let's go ahead and fire away at you here. Risk and success. How you handle your risk is directly and definitively correlated to your success in the markets. Too much risk, you're going to panic, and you're really going to close positions and lose control of those positions at the worst possible time. And, the irony, I guess, of that is people are incredibly easy to predict. They're so consistent with panic. And anyone that has been an investor, anyone that has been a trader knows precisely what I'm talking about in this particular instance over here, that too much risk, you panic, you're out, you're done. Great. Everybody recognizes that, or you get stopped out. And when you get stopped out, it's the worst possible moment of your entire life. These things never happen in a timely fashion. So let's continue from here, but that's part of the theme, of course, of surviving volatility, and that's what we're trying to get into, right? The skill set to survive volatility. So the next thing we're going to talk about is expect what I call the unexpected. First and foremost, okay, you want us to be able to survive in volatility. Now, this is such a timely topic. Number one, we've been seeing the NASDAQ. If the NASDAQ is not throwing off warning signs, well, maybe you should listen to the S&Ps that just went down 20, points in today's trading session. But in expecting the unexpected, what that basically means is plan for anything the markets could throw at you, right? Trading is a game of chess. And that, strategically speaking, a decent chess player can see their opponent's possible moves, okay, and calculates probability 4 to 5 moves into the future. That's it. That's the game of chess, right? So just take that concept and use it in the markets. And again, it's a very easy piece of logic. And again, you may not know where the markets are headed, but you can plan for the possibility, right? You can plan for each and every outcome. Like, how hard can that be? And if you think about it, and again, we have to come in here and I say, check your baggage at the door. Because people get upset when I start saying, well, listen, we're very likely going to be entering a much more volatile period of time. And we're seeing some pretty big bouts of volatility. And without unequivocation, I say that you're on edge right now because you've seen the market throwing off a couple of signs of volatility. Everything that you see in the news right now has turned utterly hideous and negative. And that, by the way, speaking of hideous and negative, we have a jobs report coming out on Friday morning. Oh, that's tomorrow morning. But again, we all have preconceived notions of where we think the markets are going to go. I'm telling you right now, forget about even my notion of where I think the market's going to go. Check the baggage at the door. Please set aside any preconceived notions on what you think can happen in the markets. When volatility hits markets, your risk has to be in check. Good risk management starts, okay, with the easiest idea. It's a perception that anything can and will occur. Prepare yourself for any event. As I say, how hard could this be, right? Markets can move up, they can move down, they can move sideways. That's it. Now, reflection time in the market. Have you ever had on individual trade that was going against you, okay? And near the moment that you bailed out, the markets turned around. So, of course, admitting that is the first step. And nobody ever wants to admit that stuff. Oh, that never happened to me, right? Everyone barfs up trades at the worst possible point. And by the way, if you traded at all or invested at all, you'll know exactly what that means because that reference, what they call barfing up a position, it's called puking your position. Unfortunately, as I guess horrendous as that term happens to be, that's what it's called in the markets. People are like, oh, I puked up my position today, which basically means you tossed up your cookies, gave up, and closed out your position. So it's something that I want you to reflect for a moment on some of the not so good aspects of what you've done in the marketplace, because when you focus on what you've not done well, you can actually correct and make that a little bit better. So then we go to, I can fix it, and I know I can fix it. So let's get to that. Fix is a dirty word in trading. We're going to hit a couple of sore spots early on over here. Fix is a dirty word, right? 15 years in the brokerage business, I'm totally cynical regarding good trades gone bad, right? Would help if I actually spelled cynical. Anytime you're fixing a trade, you're adding more risk to an already losing trade and racking up transaction costs. Sure, some fixes may work, but the very notion of fixing a trade throws good capital after bad. One of the first things that you guys learn in this business, what is it? Seriously, what is it? Don't go out there and chase trades that are not working. Yet, I'm not chasing it, Don. I'm fixing it. Okay? So what does fixing do? More commissions, more risk. There is no way possible to fix trades without adding more commissions and more risk. So again, tonight, check the baggage at the door, right? Come in here. You don't have a lot of preconceived notions. Fix something is a dirty word. So I just wanted to hit a couple of sore points because when we start cresting into more volatility, listen, here at TheoTrade, we get thousands of emails, literally now thousands of emails every single week. And when volatility starts to grip hold, we can already see an increase in the number of emails, and it's usually, help me, I'm getting beaten up in a Tesla trade. Well, good luck there. I mean, things just, 386 down to about 300 today. So that's the kind of emails that we get. So we're trying to get ahead of the curve over here. Expected moves. Risk can only be controlled if we have some measure of expectation. Now, this may be the portion that's a review for many of you, so I'm going to rip through it kind of quickly over here, but we're going to talk a bit about expected moves. What do you expect? The first step in risk management, okay, in really one of the primary skills that we're talking about this evening in surviving volatility, you have to have great degrees of risk management. You have to kind of get a feel for what to expect over there, know what to expect, and know what the unexpected holds. And of course, that's again, a little bit of a play on words over there, but what I'm referencing is it's probabilities in trading and expected moves. So let's go ahead and get started with this. Options pricing. Do you trust options pricing? Now, I said the O word. Listen to me very carefully here. I don't care if you've ever had options experience. That is not the point of this evening's session, okay? I know. Options, every time I say options, somebody's like, oh, that's it. I tune out. I've checked out. I'm out of the business. And the thing is with option pricing, I always say, do you trust the prices in your screen? There's now 15 exchanges in operation, and there's billions of dollars of risk. For the most part, option markets in liquid products have become relatively efficient. It's just something to start with because the options, what are they doing over there? I mean, what do option markets tell you? Option markets are future risks of an underlying or product. So what that basically means is, you're looking at a chart all day long. The chart's and it goes up here, and they go, oh, it tanks. And what do they call it? They call it Tesla. For the record, I'm short Tesla. Anyway, so you get some stock that tanks over here. And everything that we do all day long, and again, I'm picking a little bit on some of you, but everything we do all day long is trying to assess, what's going to happen next in the marketplace. I mean, what do you think an option market does? All right? What do you think an option market does? It's trying to price the future. That's what it is. That's why options have dates. That's why they're 7 days out and 14 days out and 21 days out and 28 days out. Oh my. They're trying to put a price tag on risk to the future. Okay? Listen to what risk is saying. Risk on any given product translate to option pricing. That's what it is. Well, this is a very risky product. Okay? When somebody says risky, what are they saying? Jack up the price of the options. That's all it means. Option markets, they just put a price tag on risk itself. So as I was saying with this chart idea, you're looking at the chart over here. Okay, what we're going to do is we're going to extrapolate forward risk. Now, I don't know if we're going to go up, and I don't know if we're going to go down, but I can tell you, okay, with relative success, how far we can move within a given period of time. Okay, and that is going to be a distribution curve. So, options, they speak volumes. Option pricing can be extrapolated into stock price movement. This is kind of cool. It's a distribution curve, right? So, if you have a stock trading right at 100. Again, I can't necessarily tell you if it's going to go up or it's going to go down, especially in volatile times. Just please, people, put your cards on the table and accept the fact that tonight is probably not going to be about, Don, Are you going to talk about Fibonacci's and us and the market going up? No, that's not going to be tonight or ever. Again, I come from, the professional side of trade over here. We're not so inclined to worry about, like, are we going up or are we going down? Yes, we are. We're going up and we're going down. The bottom line is we've got to worry more first about the risk. You want to be able to survive in any volatile situation. Doesn't matter whether you're bullish, whether you're bearish, whether you're neutral. Okay, you must adhere to a couple of ideas that we're presenting here. So again, option pricing can be extrapolated into stock price movement. Now let's get interesting over here. Extrapolate stock movement from options pricing. To understand how options can define future moves on a stock, we need to examine implied volatility. So what can implied volatility do for you? What have you done for me lately? First of all, volatility is a word that's thrown around like all the time in the marketplace. Everybody's like, oh, I like talking about volatility. Hey, listen, just cut all the, the chatter out for a second and think about this. What does implied volatility really mean? What does implied volatility? Because everybody's like, oh, the market it's getting volatile out there. It's getting volatile. No, there's two types of volatility. There's historical volatility, which is how fast like stocks themselves are moving. But then what we're talking about right now is implied volatility. And implied volatility, what is it? It's derived directly from the option pricing. And implied volatility, okay, it's completely different. So the fact of the matter is, if you think about the market going up, let's think about the market going up over here. See if can I draw the market going up? Come on. So the market starts to rally. By the way, yes, this is the market. It's the worst chart I've ever drawn. As the market goes up, let me ask you a question. And seriously, these are not, these questions, they're not open for discussion. Answer them, people. As the market goes up, where does implied volatility go? So imagine like this being the Dow. The Dow goes up. Implied volatility of options goes down. As the market goes up, implied volatility goes down. So don't confuse implied volatility, okay, with just movement, because movement alone doesn't do it. Volatility that we're talking about is markets definitively moving down. So when people like, oh, I think the market's going to get volatile, haha, gotcha, because that means you're bearish, all right? Now, the market could be volatile and end up in the same location, but for the most part, the volatility out there does imply something, and it implies you're bearish. So a little bit about implied volatility. We'll have fun with this. Volatility is always quoted in percentage terms, and it means standard deviation. Okay? So when you have a stock trading right at 100, let's key into this. So here's a stock and it's trading at 100. That $100 stock has a 20% implied volatility. What that can be extrapolated to is it means standard deviation. It means the stock can go up about $20 or down $20, and it's supposed to stay in that range. How often is it supposed to stay in the range? About 68% of the time. Now, we just threw like big numbers at you, and you're like, what? Okay, that's what implied volatility does, right? That's literally what implied volatility does. Implied volatility, what it's trying to do is handicap risk. So all the time when option pricing goes up and option pricing goes down, okay, when option pricing goes up, that's the implied volatility increasing. When option pricing goes down, that's the implied volatility decreasing. All it's trying to do is handicap how far the stock is likely to move. And by the way, option pricing is really good at handicapping moves. If this thing says it's supposed to move 68% of the time, pretty much does. If you looked at a graph, if you will, of 100 different stocks and their implied volatilities, it actually forms almost a perfect distribution curve. And that's looking at 100 different stocks over like the last 5 to 10 years. Okay, we've actually run all kinds of data sets on that information. So when you look at this, this is the stock moving up $20 or down $20. So it's going to move plus 20 or minus 20. But here's the key point. This happens to be within 1 year of time. It's in one year of time. But back up for a second, okay? Back up for a second. So you take this implied volatility number, and we can extrapolate how far the stock is supposed to move. Suppose, to move. Yeah, but I'll tell you what, it's better than, throwing darts at the broadside of a barn, okay? Because this is relatively accurate. And if you're trying to gauge your risk, how can that help you? How can this help you gauge your risk? Well, if you know a stock is likely to move in a $20 range, higher or lower, it's huge. It's absolutely huge. But this is for 1 year. You can also divide this and figure out how far the stock can move for a month. Theoretically, you can figure out how far a stock can move for a day. Everybody okay at this point? Breathe. I don't want you to panic about this expected move discussion over here. It's, for a lot of you, a little bit of a recap because I talk quite a bit about expected moves in many of the presentations that I do. But again, tonight we're using expected move for a vastly different area. We're not using it necessarily to be able to build a trade off of, okay? We're using this to understand, okay, what our risk happens to really be. Okay, everybody all right at this point? Yes? Yes? By the way, feel free. These are not rhetorical questions. You can hop in here at really any time you want. All right, everybody good? So moving forward. Implied volatility and expected price move. So what does implied volatility delineate? Implied volatility is the volatility that justifies an option's current price. That was really not a very exciting definition. How can I use implied volatility in your day-to-day trading? Well, you can use the implied volatility, can extrapolate the stock price movement or what's termed expected move. Pretty much what we showed you. Well, let's continue on over here with the idea of expected move. As I said, what you can do with options pricing is you can look at 30 days, you can look at 60 days, you can look at 90 days. Why might you want to do that? This is a distribution of price increments. If the stock starts at 100, one of the things you have to recognize, the stock starts at 100, most of the time, there's only so far a market can move within a given period of time. So if you have a $100 stock over the next 30 days, okay, again, what the options market is telling you is what that likely price movement is going to be. I can't stress this enough, okay? Now, if you had a $100 stock, okay, if you had this $100 stock, is there the chance that this $100 stock can go boop to 10 bucks? And the answer is, of course. There's always a probability, okay, always a probability of something extraordinary happening. What happens? Can a stock move from 100 to 10? Yes. The CEO gets taken away in handcuffs, but he's handcuffed to the CFO, and the stock dives $90. Okay, unforeseens can happen. Enron, I mean, come on, we could point out 500 different products in the last 10 years that have gone through different events like this, and it's that large. They're not necessarily the Googles out there, but there's tons of smaller stocks that have had wild and woolly kind of moves. For the most part, though, liquid markets. What's liquid markets? The stuff everybody owns and trades, and those products follow these expected moves almost to a T. Now, I want you to be able to use expected move. Anything I do, whether it's here tonight or otherwise, I want you to actually be able to take something away. And tonight, and by the way, I'm going to make the slide deck available, okay? So please, we'll make the slide deck available to you. I want you to be able to run this entire exercise. It begins with expected move, but expected move and probability, again, expected move defines a one standard deviation move and you give it underlying. Therefore, there's a 68% probability of an underlying closing inside of the expected move by a designated expiration. I'm going to explain this. Expected move is a probability of expiring inside a given range by a specified date. Okay, time out. You're like, you got me, man. You got me. Okay, we're now looking at an option chain. Dun, dun, dun. You don't even have to learn to trade options to do this. Options have expirations. 15 days, 22 days, 29 days, 36 days, 43 days. Over to the right-hand side of the screen, over there, that, people, is a volatility. Doesn't matter. People are like, what underlying is this? Does it matter? Seriously, does it matter? I want to know, okay? I want to know. Does it matter what underlying? Implied volatility is implied volatility. Who cares what underlying? It's Tesla. It's Facebook. It's, Joe's tree cutting service. Who the hell cares? It doesn't matter, because in the end, what risk really is defined by what? this percentage. That's what implied volatility does. Okay? And what you're looking at on the right-hand side of the screen, right over here on the right-hand side of the screen, these numbers are the expected moves. It's plus or minus 10, plus or minus 9, plus or minus 5. Now, think about this. For 15 days, we can only move $6. For 22 days, we can move $9. For 29 days, a little bit further, we can move just over $10. And for 36 days, we can move almost $11. What? Come on! Given more time, the underlying's got more time to do what? To move, because it's distribution. So you think of this as this distribution curve. Given more time, that stock is going to be able to move more, right? Everybody okay at that point? Yeah? So, moving forward over here, expected move in U. Not every trading application has expected move. And by the way, in the aforementioned slide, that is thinkorswim, okay? If you want to be on thinkorswim, that's fine. You know, over the years, and it'll be like, he's on thinkorswim. No kidding. I worked there for 15 years. A lot of the calculations and stuff I worked on. So I feel pretty strongly about talking about, you know, expected move and so forth, because, well, it was a large portion of my career. But you don't have to be on thinkorswim. Some of you guys are joining us from overseas. You know, you can't even open up a lot of U.S. brokerage accounts when, you know, if you're, I don't know, where's somebody from over here? Australia, okay? I was going to come up with something good like Canada, but Australians can't open up a TD Ameritrade account. It's unfortunate, but there's a lot of other, you know, U.S. accounts that you can open, but you can use the at-the-money straddle as an alternative to expected move, okay? Add the at-the-money call and the at-the-money put for any selected expiration cycle. At-the-money call, at-the-money put, add it together. What does it look like? At-the-money straddle. Look, here is a stock. What stock is it? It doesn't matter what stock it is. I set you up for that. By the way, it's actually Facebook, because you can see right down here. Facebook. So if you look at Facebook, I took this screenshot, and this is with 29 days remaining. If you want to know how far Facebook can move in the next 29 days, the answer is about $10. But what happens if you don't have, I don't have thinkorswim. Okay, so you can't see this. If you don't have thinkorswim, come over here, add the at-the-money call to the at-the-money put. Use the ask plus ask, and it'll equal the expected move. Okay? All you got to do, the at-the-money. What's the at-the-money? It's where the stock is trading right now. So if Facebook is at 149, okay, then use the 149 call and the 149 put. Again, you may not have expected move, but you don't need it, all right? We can round a little bit. Let's not dance around this at-the-money call plus the at-the-money put. Now, everybody okay at this point? Yeah? The at-the-money call and the at-the-money put price, they actually should be the same or relatively similar, because there's what they call put call parity, Frank, and sometimes the puts are trading for more than the calls because of dividends. Sometimes the calls are trading for slightly more than the puts because of cost of carry, which is interest rates in stocks like Google's and Amazon's. All right. With that, implied volatility opportunities, understanding volatility in expected move. It's a step in the right direction. It ain't going to get you home, but it's a step in the right direction. Your understanding of these metrics, though, can take our risk management. It can apparently take our risk management to the next level. So, yeah, but it doesn't exactly proofread itself. Let's explore implied volatility and expected moves on a couple of different products over here. So if you were to look at Tesla or Facebook or the SPX and Microsoft, Walmart, and Google, so let's go look. Now, I don't know if this is going to work, but we're going to try. This is a trading application. This is thinkorswim. That's neither here nor there. What I want you to do is I want you to look to the right-hand side of the screen. Let's go about 29 days out and look to the right-hand side of the screen. My mouse is on it. Do you realize in Tesla, yeah, we're trading like a 53% implied volatility? People, that's serious, okay? That's serious stuff. Look, we're at about 308 and change. So you round this and you add the at-the-money call, okay? Add the at-the-money call to the at-the-money put. Look, the expected move is about $36. Well, the actual expected move using a binomial regression model is $37. Come on, let's not split hairs. Close enough, right? Close enough. So that's Tesla. Tesla has a 53% implied volatility. a timeout. How does that compare to Walmart? What I want you to see, okay, is how to read implied volatility. Walmart has a 16% implied volatility. Now, it didn't matter that this was Walmart. It didn't matter, okay? I don't care. All I care is it has a 16% implied volatility. How I look at something with 16% implied volatility should differ vastly from how I look at something with a 53% implied volatility. Why? The first thing you should do, okay? I know everybody starts their analysis here, which is the charts. Well, Don, it had a gap down position over here because it came out with same-store sales and yada, 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 okay? Or they start their analysis here and they go, well, it was up here and it's forming a head and shoulders. It don't matter, because if you don't see the implied volatility, you're going to walk head on into a freight train. Did you know the implied volatility was already kind of jacked up in Tesla prior to this descent? It was telling you, dangerous, you better watch out. By the way, the volume is ripping inside of Tesla too. So starting your analysis starts here. It starts by looking at things like implied volatility. Now, how does that compare to something like the Facebook? The Facebook, 29 days out, it's got a 30% implied volatility. So Facebook is in between Walmart and Tesla, somewhere in between. Then you go to something like Google. Let me ask you guys, you think Google is volatile? Come on. Is Google, okay, volatile? Is Google volatile? I'll bring up Google. Now it's showing a 28% implied volatility. You want to know why? Because it's earnings. The earnings are actually causing the volatility. And there's earnings out in the future. The irony is Google's volatility, it's only a point or two above Walmart. It's crazy, right? Walmart can be compared to Google these days. And again, you can go through a bunch of different underlyings over here. We'll look at something like Apple. Okay, everybody's like, Apple's volatile. No, it's not. It's pretty much the same thing as Google. You just got to get a feel for these things, right? There's so much information. You can look at Microsoft, Walmart, Google. We can look at the SPX over there. What's the S&Ps? You know, people, we forgot even about the SPX. Oh my gosh. Well, the SPX, what's its volatility? Let's look 29 days out. The SPX, the granddaddy of all products, 29 days out, it's got a 12% implied volatility. Now that's scary. Not scary high. It's scary low. Very, very scary. But I wanted you to just know, okay, how to gauge risk from product to product. Now, you probably already figured out that you should treat Tesla differently than something like Walmart. You've probably figured that out. But now, using the implied volatility, you have a definitive metric to work on. You know, if one implied volatility, let's say if an implied volatility is 15% and another implied volatility is 45%. So think about this in context of a real example. You know, you have one implied volatility over here of 15%. Let's say the 15% corresponds to Walmart. Then we have another implied volatility of 45%, and that corresponds, let's say, to Tesla. How do you treat one versus the other? Come on, how do you treat it? You allocate 1/3 less capital to Tesla than you would Walmart because you're getting 3 times the bang for your buck. Done. That's how easy it is to use things like implied volatility. If you don't follow those regulations and rules, you're going to get yourself torn apart. People will allocate, whether you trade stocks, options, they don't know this stuff, and they just go out there like, well, I did 5 contracts in Walmart. I will do 5 contracts in Tesla. And that's walking into basically, you know, bullets at that point. They don't realize it. Aggregating your risks. This probably is undoubtedly the most important portion of this evening's presentation. We're going to aggregate your risks, getting a grip on the reality of your risk. And when I say getting a grip on the reality of your risk, now, this might not pertain to everybody, but how big is your risk? Next step, how much risk do you have on right now? Come on. You need to know within a few dollars. What is your total exposure to markets within a given period? Let's say that period of time is 30 days. I want you to be capable of answering today a very simple question. What is your profit and or loss potential in the next 30 days? Period. Okay? Do you know? I need to know now what your profit and loss total, aggregate everything. I don't want to hear your exposure. Well, I got $8 of risk in Google because I got me a stop order. Forget all that. What's your total aggregate profit loss potential? You're going to be able to answer this in the next few minutes. So again, taking action. First, let's look at your portfolio's value. Estimate your total market exposure. Now, I'm going after everything over here because when we originally put this class, I say when we originally put this class together, we put the class together for 401ks, for IRAs, for mutual funds, for taxable and marginable accounts, total invested funds. Not everybody in here, we were actually chatting in the room before we started tonight, and there was a kid in here. Hopefully I can call him a kid. Am I old enough to call somebody a kid now? I'm in my 40s. Can I call somebody a kid? Huh? When I started trading, I was a kid. I grew up around trading, though. But there was a kid in here who's actually a freshman in college and has already been trading for a couple of years. But if you're a kid, you might not have a 401k, an IRA, a mutual fund. And I get it, but that's okay because this still can be used. And this will transcend, market conditions over here. Take everything you got and add it together. Seriously, the actual value of your 401k. Extract, do me a favor though, extract bonds, extract them. But if you've got mutual funds, taxable and marginable accounts, total invested funds, it's going to look like this. I want you to aggregate your portfolio value. Now, I'm not going to sit here for 2 hours and aggregate everybody's risk, but take all the products you're long and or short, add up the total value. If you're using futures contracts, use the total contract value. For example, if you got one E-mini S&P 500 contract, it has a notional value of $120,000 approximately. What I want you to be able to do, though, is this, okay? When I say take the total value, not margin value, closing value. This is actually a screenshot from thinkorswim, and this is a position that I built just for this example here. This position has some Qs, right? What is the Qs? Well, I own 300 shares of the Qs, and then I got 200 shares of the XLE, 100 shares of Apple, 500 shares of the XLF, 100 shares of Tesla. Come on, you didn't think I was going to get out of Tesla, right? Bank of America and Wells Fargo. By the way, to make it clear, I actually myself do not have these positions on. I do not have these positions on. I built this portfolio exclusively for this evening because I believe that this portfolio mirrors very, very closely to what many of you may or may not have on. Okay, maybe you don't have $194,000, okay, but it's very important that you understand the concept that I'm trying to bring forth to you. If you go out and buy 300 shares of the Qs, okay, I traded them here at 132.35. They closed at 132.37. It's equivalent to $39,000 that I tied up. Again, people get this confused because they use the margin value, and margin value is wrong because margin value is only 50% of the value of the shares. So don't use the margin value, use the closing value. That basically means if you own 300 shares of the Qs, take 300 and multiply it times 132, comes out to 39 grand, right? So this is a portfolio that I created. The portfolio that I created, okay, is very, very reminiscent, okay? Frank, you're actually correct, but built this stuff back then. And Frank was actually remembering it was 2001. It's actually probably the year we wrote this original material. Wow. Frank, I'm getting old, Frank. Anyway, total portfolio value here is $194,000. So if you're taking a look at this, what it's designed to do, this could be part of your 401k. It could also include your IRA. It could include a taxable account. I don't care at this point whether you have a $2,000 account, whether you have a $2 million account. I don't care. It's the same exact logic, whether you're long, whether you're short. What I want to know, though, is aggregate exposure. Exclude for right now. Exclude for right now your options positions. And for those of you that trade options, there is another value that you can use called beta weighting. And I'll talk about that in a future time. However, for right now, the most important thing is aggregate the value. And hopefully this makes sense. Okay, after you've aggregated the value, it's about $194,000. That's what this particular account is. I own 100 shares of Walmart, 100 shares of IWM, and some Facebook, and some EM, some Caterpillar. Yeah, some, look at this. A little bit of Wells Fargo next to Bank of America with some Tesla. Great. So whatever my portfolio happens to be, it doesn't matter. It's a mishmash, right? It doesn't matter what's in it. Why do I say it doesn't matter what's in it? Because when you start adding multiple products together, what are you doing? You guys tell me, what are you doing? I'm diversifying. Isn't that what all the fund managers say? I'm diversifying into what? You're creatively building the S&P 500 all over again, sir. So you could just buy the spiders, but that's neither here nor there. Now, what I'm going to do is I'm going to take this value, this $194,000, okay, and I'm going to correlate it to an index. Select an index or ETF product having the greatest correlation to your overall portfolio exposure. Don't overthink it. Most portfolios have the strongest relationship to the S&P 500. Are we okay? Yeah, that's good. Is good, eh? Almost anything that you build has a correlation. Like people talk about like emerging markets. You know, a second ago I was like, oh, look at the EEM. If you looked at the EEM over the years, it has a beta of 1. That basically means it moves the same as the S&P 500. But then a lot of you guys have mutual funds. If you have a mutual fund, yeah, most of the mutual funds have correlations to the spiders. So as I say, don't overthink this. The spiders, the Qs, the IWM could all be possible candidates depending upon where your largest portfolio exposure happens to be. So bear with me. Look at your portfolio. Then pick one of these monkeys. Just pick one. All right? Like 90+% of the time, it's the spiders. But if you were like all into NASDAQ, use the Qs. And some people go, I got out of spiders and out of the Qs. I'm into IWM, baby, which is the Russell, okay, which is what? The little guys of the pack over there. But for all intents and purpose, over 90% of you are going to use the spiders, and I'm going to use the spiders. Now, okay, let's continue over here. So by the way, even if you don't have any trades on right now, you're okay. You are okay. Let's calculate your risk. Divide your portfolio value by the ETF product selected. We've selected the SPY, which is currently trading at around 240 bucks. All right, so I selected the spiders. Now, let me bring up the SPY. Okay, it's 240.55. All right, let's not split hairs. It's $240, right? So, listen, spiders currently trading at about 240. Our mock portfolio has a value of $194,000. How many shares of the spiders could we buy with $194,000? Pretty easy. So all I'm doing, okay, and I want to make this clear, I'm taking the aggregate risk over here. I'm taking the dollars that you have at risk, and I'm converting it into shares of the SPY. Does that make sense? Hopefully it makes sense. Okay, that's all I'm doing. So I take $194,000 and I divide it by 240. What's the 240 again? 240 is just the share price of the spiders, equals 808. Therefore, the portfolio has approximately 808 shares of SPY risk. That's it. So what I did is I took your portfolio, whatever that portfolio happens to be, it's, you know, blah, blah, blah. You're like, but Don, I have Tesla in my portfolio. Well, that's great. But in the long run, if you're well balanced and diversified over there, you're still going to have, you know, shares of the spider risk. So we have about 808 shares of SPY risk. Okay. Now, we having fun yet? Everybody okay? Everybody okay? Don't worry about beta weighting. Okay. Don't worry about any of it. Now, expected move in your risk. So you now recognize your aggregated risk and you're ready to calculate what your portfolio is likely to make or lose as the markets move. Using the product you selected, take a standard time frame, let's say approximately 30 days, and measure the expected move. Take the number of shares you are long or short and multiply this by the expected move. Somebody's like, what? All right, somebody's head just cracked open like a cantaloupe. Don't worry. It's in the slide deck here. Expected risk. Okay. In our example, we're long the equivalency of 808 shares. Can I just say 800? Can I please just say 800 of the spider? The spider expected move for the next 30 days is plus or minus $6.42. By the way, I took this screenshot late today, specifically because I wanted it to be on target for tonight's presentation. So it's $6.42 right there, okay? You can also use the at-the-money straddle, yada, yada, yada. This is for the next 29 days. But you yada, yada right over the best part. No, I mentioned the at-the-money straddle. But if you look at this, so it's a $6.42 expected move. Just take the expected move and multiply it by 808 shares. Your risk is approximately what? Basically $5,200. So again, back up for just a second. If you have 800 shares of the spiders are telling you, they're screaming to you, we're going to move normally $6.42. So if you know that the spiders are going to move in a normal fashion, normal distribution, right? You're going to have profit and loss deviation of $5,200. Just round it, right? So let me actually redraw this out for you guys for a second. You're going to have a distribution curve. You're going to have plus 5,200 or minus 5,200, and you pretty much have a 68% chance of plus or minus $5,200 happening. Okay? You guys okay? Time out. Are you comfortable with that? Are you comfortable with your portfolio making or losing $5,200? Question mark. I can't answer that. You have to answer that. By the way, this is not open, you know, listen, it's okay. You can come in here and say, yes, I'm comfortable with that. Some of you are like, Don, if I lost $5,200, okay, I would have to wear a diaper. And I get it. That's what I'm trying to get you at. I want to know your break point. If you don't know your break point, okay, then what's the point of this entire exercise? You got to know what your break point is. What do you mean break point? When are you going to break? When are you going to fold? When are you going to panic? What, do you think you use a stop order out there? You can't use a stop order. A normal move in the next 30 days here is $6.40. We haven't even talked about real risk yet, calculating the extremes. Oh, let me clarify. With 800 equivalent shares of the spiders, you're taking a 68.3% chance of seeing basically a $5,200 profit and loss swing inside the next 30 days. Right? Now take that number and double it. Now triple it. To account for less probable events, you must assume you could see the market move 3 times the expected move at least 1 time per year. Oh, now we're having fun. Because I told you, you know, this stuff, everybody, and I say this almost every presentation I do, everybody always wants like instant coffee, instant tea. They're just like, is this not the lecture where they show me the red and green flashing arrows and I make money from following a system? No, this is actually your reality because there is nothing that sees, okay, direction and volatility coming. But we do know, okay, what less probable means. You can assume at least 3 times the expected move event at least 1 time per year. Okay? Last year was actually considerably more than that. Last year, if you actually looked back, dun, 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 okay? By the way, Don has been tracking this stuff. Don has been tracking expected moves for a very, very long period of time. And if you look back over the last 3 years, okay, the last time we made a large 3 standard deviation move, okay, it was December 7th, 2016. It's right here on your chart. Go check it out. December 7th. It's Pearl Harbor Day. We made a 3 deviation move to the upside. The election was not a 3 deviation move. It was actually priced in. Prior to that, this is Brexit. The Brexit down move was priced in. The Brexit up move was a 3 sigma move. It was a 3 standard deviation move. This is where charts kind of matter, okay? This was actually priced in. It was a fairly wild sell-off that happened in the beginning of 2016. Craziest thing? This is a 3 deviation move to the upside. The interesting thing is many of the moves to the upside. Then we come to a 4 sigma move. Dun, dun, dun. August of 2015. I can show you this time and time again. There are so many statistics that we run here at TheoTrade, and that's what we do. But I want you to basically run this and say, if your expected move is $6.42, take it and triple it. That's equivalent to what? That's equivalency to a $19 move. So 3 times the expected move. It's basically 19 times 808. It's $15,562 a risk. Yeah! Can you feel it? It's a $194,000 portfolio. It's a $194,000 portfolio. It has an unlikely chance, but a possibility of $15,500 a risk. Now, here's the real question. How's that feel? Ask yourself every single step of the way, am I comfortable? You got to play that game, go fish with yourself. Go fish. All right, am I comfortable at this level of risk? If the answer is no, you either need to lighten the position or learn to hedge risk. Hedging is what we do. You can lighten the position up. There's nothing wrong with like lightening the load. Like I'm in a little bit too deep. Like right now, I'm getting on average of about 15 emails a day right now with this very one question. The very question is a very simple one. I'm thinking the market might turn down. What do I do? Well, you either start bailing out of a position, which if I suggest that, you turn around and go, what about taxes? Yeah, what about taxes? Or you better learn to hedge. In risk management, you must never assume the market's going to go up or down. You just take a probability stance based on expected events and weigh that against an individual appetite for risk. That's how easy it is. Are we good? Going through that exercise, people, all you got to do is follow these steps, okay? Follow the steps. I mean, that's what we do here at TheoTrade is we build criteria, we build recipes every single step of the way. And I stress to you guys, this is the most important exercise you can go through. I mean, I've taught this to portfolio managers for the better part of 15 years, and most of them are shocked when they go through this. They're like, wow, we never looked at the options market to handicap our risk. Volatility, odds and ends. Additional considerations for volatile markets. Look, do we know if volatility is going to hit? No, but we do know one thing. It will hit sometime in the future. There's constant conversation about volatility. There's constant conversation about suppression of volatility. We all see it coming. We are in a rising interest rate environment. The Fed is now pulling back, okay? What are they pulling back? The juice, people. What's the juice? Well, they're pulling back easy money. You better have considerations for volatile markets. Size matters. Ha! Love that. If you were used to trading in a 10 VIX, a lot of you guys got involved in this business. If you've been involved in this business the last 5 years, you're just used to trading in a 10 VIX. What's the first thing you should consider when volatility spikes? Question mark. The higher volatility directly implies you get more movement in an individual stock or an overall market. The bright side is you're going to get a lot more bang for your buck. Listen, volatility, it's where I made my entire career. But the first thing you got to do, you got to cut your trading size in accordance with the increased movement in markets. If volatility doubles, you can literally half the size. Look, you're trading in a 10 volatility. All of a sudden, boom, now you're trading in a 20 volatility. What do? Cut your size in half. Why? Because the market's now implying twice the movement, right? And it's about magnitude. So again, kind of read through that one on your own a little bit. You got to have the slide deck over there, but size matters. You better scale. You better scale in accordance with what volatility is. I say a 10 VIX, but goes the same thing as like, hey, you're trading Walmart, and 2 seconds later you're trading Tesla. You know what actually cracks me up? Let me show you guys something fun, because this one really gets me going. People trade products like the VXX. The VXX. What's the VXX volatility? Have you ever asked that question? It's 80%. Have you ever traded a product that has 80% implied volatility? You're like, no, because I never looked at the volatility. You're trading an 80% implied volatility. What that basically means, you better put your helmet on, because even you thinking Tesla's volatile, Tesla's only 50% volatility. The VXX, it's an 80% volatility. You want to get crazy? Let's get crazy. Go to UVXY. That's 160% implied volatility. Helmet on, seat back in the upright lock position. Because you know what? I worked at a brokerage firm for 15 years. More people lose money in these products than anything because they don't understand position sizing in them. Size matters. Stop orders work all too well. Sure, stop orders are going to work maybe a little too well in periods of heavier volatility. Okay, you must consider the probability of being stopped out. It's greatly increased. Why? Because more movement, and again, more movement translates to a higher probability, okay, of the distribution curve in touching a stop order. It's huge. Stop orders, if utilized, must be placed further away from the underlying instrument. Use expected move to help you determine viable placement for stop orders. As the stop order is placed further away, the underlying price, you're left with more risk. Oh, ingenious. So you cut your trading size in a more volatile marketplace. Everything leads back to the exact same idea. You got to cut trading size in heavier volatility. Next, liquidity matters. Trade liquid markets. Liquidity tends to concentrate in limited products during episodes of intense volatility. That basically means this. When things get crazy, bid-offer spreads get wide. Okay? You are going to get clocked in the bid-offer spread, and even the most volatile and most liquid products out there. The bid-offer spreads are going to widen out. Even the most liquid products, you may not be able to get out when you absolutely need to get out. Never place yourself in a position of needing to get out. And yes, I'm talking about you, you iron condor seller people. So if you don't trade iron condors, that was not directed towards you. But there's one thing that you better keep in mind right now. It looks like we're on the verge of, we're getting a little bit more serious, right? If you need to get out of something, you're not going to be able to get out if it's a really volatile day. Let's make that clear. You know, if you look back at like August 24th of 2015, I traded that day. Okay, and guess what? The first 20 minutes of the open, you couldn't trade. Everything was locked down. The NASDAQ wasn't even accepting orders. It was a free-for-all. Okay, you think if the market really is going to start tanking one day, you'd be like, yeah, I was able to get out of my position. You ain't even going to get out with a market order, okay, because it's not going to route. Don't rely upon your technology. Don't rely upon bid-offer spreads. If the markets start to tank, okay, it's every man, woman, and child for themselves. The volatility crush. In the midst of volatility, you may be so inclined as to want to purchase a call option, thinking the market may rally. Sure, the markets can rally. Indeed, they might rally. However, you're not going to profit due to the impending volatility crush. As markets rally, volatility gets crushed, especially after large down moves. So what I'm basically propositioning here, again, this is volatility odds and ends. Markets start coming down, they're tanking, and all of a sudden, pop! Right back in your face. Out here, you go and buy a call. Why? Because you had red and green flashing arrows that said, buy a call. You can buy a call, but you're not going to make money. This is the most serious mistake that I have watched people do forever. Buying an at-the-money or out-of-the-money call, it's a serious mistake as it leaves you exposed to significant volatility risk. If you're intent on buying options, use an 80 delta or higher in order to avoid the volatility crush. Do not get volatility crushed. You have been warned. So it's just something that it just kills me because you want a perfect example right now? Go take a look. Look no further than Tesla. Whoops. It would help if I actually typed in Tesla. Go take a look at Tesla. Stock is tanked. If you want to look at volatility, look at the volatility. This is a one-year volatility. Is it up there? Oh, yeah. It's getting up there. I like it, right? Party's coming. You know this thing is going to bounce. Come on. It's there for the taking. You open up options. If you buy a call, you're done. You're done. It doesn't matter if the stock rallies. The stock will rally all the way from 308 right back to 320. You're going to buy an option for $7.50, and the option's not going to move in price because as the stock's going up, the volatility is going to get crushed. There is a way around this. You can actually use the vertical spread. Use what's called an in-out spread. Buying or selling vertical spreads can and will mitigate your volatility exposure, okay, in the event you want to go long in these markets. I mean, there are so many little nuances of volatility, and I want you guys, number one, and I want to give you a couple of ideas over here. Number one, we don't want you to just survive volatility. I mean, that's the name of tonight's presentation, right? Survive volatility. I don't want you to survive volatility. You have to be able to thrive in volatility. And there are so many little nuances to be able to survive in volatility. So what we have done, and this is the official announcement, okay, for everybody, we're going to be preparing you for volatility for, well, the entire next week. And we're doing that. TheoTrade could prepare you, I should say, for volatility. I'm bringing back the Greek week. Greek week! And we are, and I'll explain this here in context right now, we are inviting, okay, non-TheoTrade members to join us in the TheoTrade room for an entire week. We are giving you, okay, a pass into TheoTrade for an entire week. And it gets better than that because forget about bonuses and so forth right now. By the way, the whole thing is only $47 and it's all archived. But we're going to do a Greek week. It's Delta, Gamma, Theta, Vega. It's what you need not only to manage risk, but to thrive in the midst of volatility. If you can read the Greeks, okay, you master risk. That's what this business is about. It's about mastering risk. The Greek week, I started that years ago when I was at thinkorswim, and it's something that's just kind of lived a little bit in infamy. We're now bringing the Greek week to TheoTrade, and it's awesome because we're not restricted anymore. You know, when I was back at TD Ameritrade and thinkorswim, you're restricted in what you can say. Now this Greek week, it's going to be, you know, no holds barred. I'm really excited about it, but I want to explain something. For those of you that are not members of TheoTrade, if you are tuned in and listening to this right now, for $47, you don't just have access to the entire week, okay? We're going to give you access to our coaching archive. If you sign up for this tonight, you can start binge watching every episode, okay, every coaching session that you can imagine. You have an all-access pass for an entire week. I believe we're cutting you off the following Saturday, okay? And check for that for sure, okay? It's $47 for the entire thing because, again, we wanted to get everybody and prepare for some volatility. But maybe you're not available during the entire trading day. By the way, this Greek week is giving you access to the live trading room. It's not just a couple of sessions over here, and I'll explain this. It's 5 full days of live trading, including detailed Greek week coaching sessions. The Greek week coaching sessions are going to be starting each day. And again, we give you access to the entire trading day. The actual Greek sessions are going to be starting, all right, about an hour after the cash open. And there'll be a multitude of 5 total coaching sessions amounting to about 9 full hours, okay? And that 9 hours, you'll have unlimited access to the on-demand recording over there. The entire chat room, if you've never seen the chat room, I will show you precisely what it looks like, okay? This is it. This is TheoTrade. They're watching it right now. This is everybody in the chat room, okay? So there's tons of people in our chat room over here on a day-to-day basis. We're not just giving you access to this chat room. By the way, Stuart, we're going to teach beta weighting method in the Greek week. Ha! What do you think I was waiting for, man? I'm priming the Greek week, baby. I like the Greek week. And by the way, a lot of courses I've taught over many, many years, no doubt, Greek week, that's my thing. Like, I learned to trade via the Greeks. I worked for a derivatives firm, and all I did was manage risk and manage via the Greeks. So Lifeline. What we're giving you access to for a full week, it's over here. If you come to this member chat room, in the member chat room, go to archives. We're giving you access to the coaching archive. You don't have by the way, you do not have access to the class archive. The class archive is the most coveted area of TheoTrade because the classes themselves, you know, they're $300, $400, $500 a piece for the classes. But we're giving you access to the coaching archive. The coaching archive, it's everything we do on a day-to-day basis, all the way back. Okay, each one of these, if you open it up, like, well, there's only 3 coaching sessions. I'm sorry, we're only into July a few days. But if you want to look at like June coaching sessions, here they are. We're going to give people access to it all. By the way, this is a fully searchable database. If you go to member home over here, okay, you just type in something in like expected move. If you want to type in expected move, go for it. Everything we've ever done about expected move, options 401, expected move essentials class, all right, you know, coaching session, extremes expected move, coaching session, plotting the one-day expected move. That one is ridiculously sweet. By the way, write this down right now. Write down expected moves. Type it in over there. The other thing we're going to give you access to, we ain't done yet. You can click on Start Here. So if you've never been in TheoTrade before, you can click Start Here. You go watch 101, okay? All the different parts of 101, all the different parts of 201, all the different parts of 301. You can watch Order Execution Part 1, 2, and 3, a crash course in option Greeks. Get ready, okay? You need to start watching this stuff. It's Thursday. You have till Monday, okay? And by the way, we're not just giving you access to that. You can be in the chat room each and every day with us. We do live trading in here as well, okay? You're going to hear about like Tony Rago and NASDAQ futures. It goes on and on and on and on. Again, we're watching me, watch me. So, by the way, I thank everybody that's in the chat room over here. This is why I'm a total Theo member. Oh, is there some time devoted to hedging? Yeah, there is going to be time devoted to hedging. What is a Greek? It's a toga party, Joseph. It's Delta Gamma Theta Vega. Let me explain in detail right now. By the way, for the 47 bucks, you know, I get excited a lot of courses. 47 bucks, okay? You can lose $47 in a second, literally in 1 second in the market. If you were to look at like my account moves in more than $47 increments every time the market ticks. Literally, my market, you know, the market moves more than 47 bucks. 47 bucks. We're basically, the only reason we're even charging $47 is to get you people to commit to something out there. Let me bring up the actual website. Okay, this is what Greek Week is. This is exactly where you sign up. Go to TheoTrade.com/Greek. It's TheoTrade.com/Greek. Okay, you don't have to worry about capital, nothing like that. It's /Greek. It's the Greek Week plus, okay, plus the full sessions of live trading, includes unlimited access to the on-demand recordings. But again, the second you sign up for this, you can start going through the coaching archive like immediately. And again, it's all access pass. It's like Netflix of like TheoTrade for an entire week. And listen, you can come into the chat room tomorrow, you can come into the chat room next week, is ask questions and so forth. We're all there. And it's, you know, myself, Jeff, you know, Tony Rago. So what the Greek Week consists of, specifically the Greeks, how to use Delta, okay, to actually really get a better grasp of risk. It's to minimize your risk. You're not going to struggle with risk again after you understand your Delta. We are going to talk about beta weighting. We're going to talk about Delta hedging over there. We're going to know how to look at our risk, all right? We're going to know how to evaluate the risk, but more importantly, you're going to be able to do things with your positions that you never dreamed possible. We're going to show you how to do a hedging technique with futures contracts. We're going to show you what theta is. Theta is the, you know, what? It's time decay, the daily whittling down of an option's value. We're going to talk about gamma risk. You're going to understand the market making side of the business over here like never before. You know, what strikes to select. Again, very, very few people understand the Greeks. We're going to get you inside of a week. I promise you, you people will master Greeks inside of a week. I've never gone to this depth that I'm putting together for this Greek Week over here. So we're also, again, you know, as we're saying, put the theory into practice and look over my shoulder. You'll be able to see our screen the entire week. It's unlimited access to the on-demand recording of myself and the rest of TheoTrade team that take place from Monday, July 10th, July 14th to learn. Again, everything is going to be on there. In addition to it, we are giving you the bonus classes. If you know nothing, okay, nothing about options. We have options 101, options 201, options 301. A lot of you guys that are tuned in, okay, you've probably already been through these classes. That's fine. Go through them again, okay? I just want to prep you for it. Now, in addition to it, okay, people, if you want the all-access pass, it's 47 bucks. And again, it's next week. And I know some people are like, well, I got to work. It's okay. Everything is recorded in real time. Just go back through it in the archives. And at night, you could just basically tune in and check out coaching archives. You know, the one thing I try to get you to do, if you're going to pay the 47 bucks, try to listen to at least one coaching archive a day, okay? Commit yourself to that, even if it's not the Greek stuff, because the Greek stuff, you're going to have unlimited access even after this week to the Greek stuff. But commit yourself to some random coaching session. I mean, there's coaching sessions in here, like if you want to know about intraday trading, there's a coaching session on it. You want to know about like tick charts, there's a coaching session on it. You want to know about Fibonacci's. I make fun of it, but there's a coaching session on it done by Jeff Bierman. You know, you want to know anything that you can dream of in trading, I bet you we have an archive for it, and we'll point you in the right direction, but it's fully searchable. In addition to it, if you want to go full-blown, what we call total Theo, what's for 997 bucks? $997 gives you access to everything that we do for an entire year and it gives you every single class we've ever done retroactively, meaning that if you looked at TheoTrade, when I talk about like going retroactive, when you look at TheoTrade, the most valuable area of TheoTrade is undoubtedly the classes. You know, most places you go, they charge you $1,000 per class. We charge you $1,000 for everything that we've ever done and everything that we're going to do for the next year. You know, again, it's no questions kind of asked over here. Our archive is paralleled anywhere in this industry. Right, we have 5 full-time instructors. It's not just Don, you know, it's, you know, Don, Tony, Doc, Slim, you know, Jeff Bierman. All of us are inputting to this. And, you know, I know that people look at this and they say to themselves, you know, let me just flip this back up here. I know a lot of people, they say to themselves, you know, $47 is an unbelievable deal. It is. $9.97 is a smoking deal. $9.97 is handing you guys so much that you're going to be blown away. I mean, but if you're going to pay, you know, $1,000, would you rather be overwhelmed or underwhelmed? I'd rather be overwhelmed. And you will be, okay? A few months into this, you'll probably be asking for more. And it's important that you know there's always more coming. We're always adding more. We email out trades, okay? We try to give you everything you need. We don't charge you for studies and so forth. If you have like different technical studies, we give them to you. Constantly in development of new studies and so forth. We give them to you. We have a number, okay, of scripters. So it's all included. Again, TheoTrade.com/Greek. I also stress to you, all of our contact information is on here. You can actually, you know, hit support chat live right now. We are here. We're here to answer questions, but we want everybody that's in the chat room right now. We want everybody in the Greek Week. We want to pack the room. We can fit unlimited people in for next week. We actually have a system that can broadcast to literally, you know, tens of thousands of people at one time. We run more like a TV studio than we do like a webinar here. Anyway, if you need to get a hold of us, support at TheoTrade.com. We also are 1-800 number 800-256-8876. I don't know if there's too many questions. Come on, it's a $47 entire week all access pass to us. Or hey, listen, okay, the total Theo, it's totally worth it. I hope that having gone through what I did tonight, just a little bit of risk management discussion tonight, I hope you guys realize the value in that alone is uncompromising. The value in just what we do for free. Imagine what we do, you know, when somebody pays $47 or when somebody pays $9.97. We strive to knock it out of the ballpark every single day. We're constantly doing research, adding to this. With that, I want to thank everybody for tuning in tonight. Again, if you have questions, TheoTrade.com/Greek. Those of you that are live in the chat room right now, hey, thank you very much for joining us this evening. Again, for those of you that are in the chat room, if you want to see again what that chat room looks like, here we are, okay? And, oh, some great comments. Tim, best deal in trading education is Total Theo. Best place to learn. By the way, these are clients, okay? I don't want anybody to think, you know, this is a random person named Kevin. These are not people we're prompting in here. You can see how many are in the chat room over here. And we're doing this not as just to be a trial run. We're doing this because we really want people to understand, right? We feel pretty strongly volatility could get serious over there. Walk in at least with the right tools to know what you're doing over there. So thanks, everybody, for joining us tonight. Again, I will throw this web address again back up over there. Have a great evening, everybody. Bye-bye.